Hi, and welcome to the Stock Market Palantir. Don't forget to subscribe and drop your comments below. All right, let's see the analysis.
$2.30 to $2.36. That is the extremely tight training range for ZipRecruiter, ticker ZIP, as of February 20, 2026.
Yeah, and just earlier this month, it actually touched a 52-week low of $1.65.
Exactly. It's a dramatic shift.
The market cap is the number that really stops you cold, though. We are looking at a market capitalization of right around $201 million. And let's remember, this is a company that peaked at nearly $3 billion in late 2021.
Right.
The acceleration of this sell-off is just undeniable, down 36.07% in market cap over just 30 days, leading up to mid-February. And if you look at the volume spike on February 11th, 1.75 million shares traded on a down day. That signals one thing very clearly to me: institutional redistribution. The smart money is, well, it's crowding the exit doors.
Those are Graham numbers. I mean, there was absolutely no way to sugarcoat a $200 million valuation for a company that was once, a darling of the digital economy. But that brings us directly to the central question of today's debate. We are looking at source material that asks a very specific high-stakes question. Can ZipRecruiter generate a 5x return over the next 10 years?
Well, a 5-by return implies a recovery to $1 billion valuation. And given the data I just read, that feels a lot less like a credible investment thesis and more like, frankly, a prayer.
Or I would argue it's a calculation based on a historical anomaly. We have to contextualize this collapse. We are in the middle of what the company's own internal research calls the Great Freeze. Employee turnover has absolutely plummeted. It went from 177% in 2023 down to just 50% in 2025. The median time to secure a job has jumped from 57 days to 83 days. This isn't just a ZipRecruiter problem. The entire labor market has effectively calcified. So my stance today is that the market has massively overcorrected. I see ZipRecruiter as a fundamentally sound business undergoing a necessary pivot to AI-driven, high-intent matching. At $200 million, it's priced for bankruptcy, but the data suggests it is actually a massive buying opportunity.
And I will be taking the stance that cheap is not the same thing as value. We are looking at a classic value track peer, one that is facing existential structural threats. You mentioned the Great Freeze, but I see a debt wall looming in 2030, the threat of agentic AI making aggregators completely obsolete, and perhaps the most alarming signal of all, which is insider selling at all-time lows. This isn't a turnaround. It looks like a distressed asset that is slowly winding down.
Okay, then let's get right into the position statements. I want to lay out the bull case for transformation first. I see a dying business. I see a business that is successfully transitioning from a volume model to a value model. And they're doing it precisely because the Great Freeze forced their hand.
Go ahead, make the case.
Look at the most critical metric in the report. It's the one the market is completely ignoring: revenue per paid employer, or RPPE. Now, if this business were dying, if the core product was losing relevance, you would expect pricing power to collapse right alongside the volume. But look at the third quarter of 2025.
Right.
RPPE has risen to $1,717. That is significantly up from pre-2021 levels, which were sitting around $1,093. Even in a historically soft market, they are extracting significantly more value from fewer customers. That proves that unit economics are actually improving. They aren't just selling cheap job slots anymore. They are selling targeted results.
But are they really extracting value, or are they just squeezing the remaining customers harder? I mean, that's a classic sign of a declining monopoly or a legacy platform. You just raise prices on the trapped user base before the lights go out.
It's not squeezing, though. It's actual product innovation. Look at the launch from January 2026, the Be Seen First feature. This is a fundamental shift in how the marketplace works. It uses purple badges, personalized notes to hiring managers, and algorithmic boosting to signal high intent. The data shows that candidates using this feature are nearly twice as likely to initiate conversation. And regarding their future relevance, Their site visits from generative AI tools increased 140% sequentially. They are positioning themselves not just as a legacy job board, but as the primary data source for future AI models like ChatGPT-5. This is a technology company executing a pivot.
I appreciate the optimism, really, but I have to look at the actions of the people who know the company best. My bear case is built on the reality of structural decline, and the loudest signal is coming from inside the building. You talk about a 5x return, this great path to $1 billion. If that is true, why is management aggressively selling at multi-year lows?
Well, executive sales happen for a multitude of reasons. Tax planning, estate management, 10b5-1 plans.
Sure, but look at the specific timing and the price points. In early February 2026, CEO Ian Siegel sold over 29,000 shares at prices between $1.97 and $2.25. The CFO and the chief legal officer also sold shares. I mean, if you truly believe your company's about to pivot to $1 billion valuation, you do not sell your shares for less than the price of a fancy cup of coffee. You buy. You mortgage the house and you buy. This signals to me that management sees risks the public market is only just beginning to price in.
Or they are just diversifying during an open liquidity window. But go on, what is this structural risk you're pointing to?
We have $550 million in senior unsecured notes due in 2030. Right now, as we established, the market cap is basically $200 million. The debt load is more than double the entire equity value of the company. And these notes are trading at a steep discount, yielding roughly 16%. For our audience who might not follow the bond markets closely, a 16% yield on corporate debt is the credit markets screaming high risk. It's a distress signal.
The debt is definitely a concern, I grant you that. But it's not due until 2030.
We will get to the timeline later. But when you combine insider exits with a $500 million debt burden, the deep value argument starts to crumble pretty fast. You're buying a call option on corporate survival, not a value stock.
Let's move to the core debate then. I really want to start with this AI pivot because I think you're dismissing it way too easily. You called Be Seen First just a feature, but I see it as the explicit solution to the biggest problem in recruitment right now, which is the application black hole.
The black hole where thousands of resumes go to die, yeah?
Exactly. Think about the legacy model, Indeed, or LinkedIn to an extent. In a high-volume, easy-apply world, employers are just drowning in low-quality applications. It's application fatigue. It costs real money and time to sift through all that noise. By filtering for candidates who are actually willing to write personalized notes and use the Be Seen First mechanism, ZipRecruiter is successfully selling high-intent signals. They are moving away from selling cheap clicks to selling verified engagement. That is a real moat. It's a defensive structure against the total commoditization of the resume.
I really want to push back on that moat concept. You're describing a slightly better way to filter a queue. I'm arguing that the queue itself is about to disappear entirely. I agree it's a nice feature for today, but does it survive tomorrow? The source material raises a fascinating and frankly terrifying concept for this industry: agentic AI. We aren't just talking about better matching algorithms or smarter search bar anymore. We are talking about autonomous software agents. If an enterprise develops an internal AI agent that can speak directly to a candidate's personal AI assistant, what happens to the middleman?
You're describing a world where the aggregator is completely disintermediated, where the hiring manager's software talks to the job seeker's software directly, without a portal.
Precisely. If my personal AI can negotiate directly with your corporate AI, ZipRecruiter's entire business model, the aggregator model, becomes obsolete overnight. Be Seen First is just a better way to organize a waiting room that might not even exist in 5 years. Why do I need a little purple badge if my AI agent has already verified my skills with the employer's agent in milliseconds?
That is a valid theoretical risk, but it's a science fiction risk profile versus a tangible reality. We have to look at what's actually happening on the ground right now. Look at the PwC 2025 Global AI Jobs Barometer. Industries exposed to AI are seeing quadrupled productivity. ZipRecruiter isn't fighting this trend. They are actually becoming the AI spear. They are moving from a reactive casting of a net to highly proactive matching. They are building the infrastructure that those very agents will need to access the data.
Wait, so you think ZipRecruiter becomes the data lake for the autonomous agents?
I do. Think about how these agents actually function.
They don't just magically know who is looking for a job or what a company is paying. They need a database. They need a validated source of truth. The 140% increase in traffic from generative AI tools to ZipRecruiter's site proves this is already happening. The agents, whether they are built by OpenAI, Google, or whoever, need to know where the jobs are. They need structured data, salary ranges, location requirements, verified skills. ZipRecruiter has that structured data. They are optimizing their entire platform to be the feed for the agents, not the obstacle. They are becoming the pipes.
So your core argument is that they pivot from consumer destination to underlying utility layer for the AI recruitment ecosystem.
Exactly. They become the plumbing. And as any investor knows, plumbing is a very good, very sticky business.
It is a compelling pivot theory. I'll give you that. It certainly changes the narrative from a dying website to vital AI infrastructure. But my primary problem is the timing. This entirely relies on them having enough financial runway to actually get there. The employers have a massive wait-and-see attitude right now. The hiring sector is incredibly soft. If this infrastructure transition takes 5 years, do they have the time before the debt comes due?
Which leads us directly to the second major point of contention, financial viability and the so-called debt wall. You mentioned the credit markets are scared. I look at the balance sheet and I see incredible resilience.
With a $200 million market cap and $550 million in debt, that looks like zero interest rate policy leverage gone terribly wrong.
You have to look at the liquidity, not just the gross debt total. They have $411 million in total liquidity. That's cash plus marketable securities just sitting in the bank. Their current ratio, which is their ability to pay short-term obligations, is sitting between 5.9 and 7.4. That is massive. Most traditional companies would kill for a ratio of 2. They have zero immediate liquidity crisis. They can comfortably service the interest payments on that debt for years.
They can service the interest, yes. They can make the minimum monthly payments, basically. But they have to pay back the principal, the full $550 million in 2030. That is only 4 years away.
4 years is an eternity in the tech sector. It is plenty of time for the Great Freeze to thaw out and for revenue to normalize.
But you have to look at the profitability timeline to refinance that. The guidance for Q4 2025 suggests $14 million in adjusted EBITDA. That sounds nice on an earnings call, but we both know adjusted EBITDA can hide a multitude of sins. Massive stock-based compensation, one-time restructuring charges. Are they GAAP profitable? No. They are still reporting actual net losses.
Yes, but they are investing heavily in R&D. 27% of revenue goes to R&D. That's a deliberate choice. They are actively building the AI tools we just spent 10 minutes discussing.
It's a choice that burns precious cash. Here is the harsh reality of the debt wall. If they do not reach consistent GAAP profitability by 2028, they simply cannot refinance that $550 million. No sensible investment bank will touch them. And if they can't refinance, they face massive dilution, issuing millions of new shares at rock-bottom prices. Or worse, restructuring. Basically, equity goes to zero and the bondholders end up owning the entire company.
Or they simply pay a portion of it down. If they have $400 million in liquidity right now and they turn the corner on GAAP profitability as the macro labor market thaws, they don't need to refinance the whole chunk. They can pay off, say, $200 million in cash and easily refinance the rest. The market is pricing them right now as if insolvency is happening next week. It's not. The balance sheet absolutely buys them the time they need.
The balance sheet buys them time only if they actually stop the bleeding. But let's assume they survive. Let's assume they don't go bankrupt. The equity market is pricing them as if the core business model is permanently shrinking. Which brings us to the valuation. You claim a realistic path to a 5x return. Walk me through that math, because to me it looks like pure Excel gymnastics.
It is actually quite straightforward arithmetic, no gymnastics required. To get a 5x return from today's price, we need to reach a $1 billion valuation. To get there, ZipRecruiter merely needs to recover its revenue to 2022 levels, which was around $900 million.
That is a staggering assumption given the continuously shrinking employer base. We are down to roughly 66,900 paid employers. That number has been sliding downward for several quarters.
It's cyclical, not structural. The Great Freeze will end. If they hit that $900 million revenue target, and achieve their stated management goal of 30% EBITDA margins, that gives you $270 million in annual EBITDA.
Okay.
270 million EBITDA? Let's assume they hit that.
Apply a very reasonable 10 times multiple to that figure. In HR tech, a 10x multiple for a highly profitable software company is standard, maybe even conservative. That creates an enterprise value of $2.7 billion. Even if you subtract the full, unrefinanced debt load of $550 million, the equity value still clears well over $1 billion. That is your 5x return. It doesn't require a magic trick. It just requires a return to normal baseline market conditions. That is a beautiful spreadsheet, truly, but it completely ignores the reality on the ground. You are assuming revenue naturally returns to 2022 levels. But the Great Freeze isn't just a normal business cycle. It's a profound behavioral shift. We need to talk about job hugging.
Job hugging?
Yes, it's the new norm, cited extensively in the material. People are genuinely terrified to leave their jobs. Quit rates are at historic, multi-year lows. If people don't quit, companies don't need to backfill the roles. If companies aren't backfilling, they do not need ZipRecruiter. This isn't just a temporary dip. It's a fundamental structural change in the labor market dynamics.
Markets always cycle, though. We have never seen a freeze last forever. Eventually, demographics take over. Retirement happens. Economic growth happens. People just get bored. Friction naturally returns to the labor market.
But we have seen legacy industries get disrupted forever. If the employer base continues to shrink because small businesses either move to cheaper, highly automated AI solutions or just rely on their own LinkedIn networks, that 900 million revenue target is a total fantasy. The market is pricing Zip for insolvency, not recovery, because the market believes the customer base is eroding permanently.
I strongly disagree with that interpretation. The massive increase in HARC-BE we discussed earlier proves that the remaining customers actually value the service more, not less. They're successfully moving up market to larger enterprise customers who have dedicated performance-based budgets. That is incredibly sticky revenue.
Sticky, or are they just the last ones left to leave the platform? You know, when the tide goes out, you see who is swimming naked. ZipRecruiter is standing there with $500 million in debt and a steadily shrinking user base. And let's not forget the sheer weight of institutional sentiment. When a stock trades down at $2, many institutional charters actually force the funds to sell. It becomes a vicious, self-fulfilling prophecy.
And that is exactly where the generational opportunity lies. When massive institutions are forced to sell for purely technical, non-fundamental reasons, smart value investors step in. You're looking at the broken price action. I'm looking at the intrinsic value of their underlying matching technology.
We are looking at the exact same chart and seeing two completely different futures.
Let's bring this to a conclusion then. We clearly have two very different views on the same set of numbers.
We certainly do.
But the fundamentals, specifically the be seen first product traction and the rising revenue per paid employer, show a business that is actually getting stronger per unit, even if the top-line volume is temporarily down due to our harsh macro environment. I would urge anyone looking at this to look past the Great Freeze to the inevitable thaw. When hiring returns, ZipRecruiter will be leaner, smarter, and embedded much deeper into the AI ecosystem.
And my conclusion is that you are trying to catch a falling knife. The combination of high debt, $550 million, against the collapsing market cap of $200 million creates a truly toxic financial cocktail. When you add executive insider selling at $2 a share to that mix, it tells you everything you need to know about the internal confidence. The deep value here is an illusion. I remain highly skeptical that a legacy aggregator can survive the shift to agentic AI without undergoing a painful restructuring that completely wipes out the current equity holders.
We can both agree on one thing, though. We won't have to wait very long for a massive clue.
No, we won't. February 25, 2026, the Q4 earnings call.
That is the immediate catalyst. Management has guided for $112 million in revenue. If they hit that, it's the very first year-over-year increase since 2022. It officially signals the turn.
And if they miss, or if the forward guidance is soft, that $1.65 low might suddenly look like a ceiling.
A pivotal moment indeed. We've laid out the bull case for the deep value turnaround and the bear case for the structural value trap.
Is ZipRecruiter a genuine bargain or is it a bust? That is for you to decide.
Check the numbers carefully. Watch the volume.
Thanks for listening.
If you like this video and want to watch more content like this, don't forget to subscribe. Thanks for watching. See you.